Welcome to the Investopoly podcast. Our goal is to share easy to understand, evidence based, holistic insights to help you master the game of building wealth. I'm Campbell Wallace, a senior financial advisor that works closely with Stuart Weems. I'll be filling in for Stuart over the next few weeks whilst he enjoys a hard earned break. What I'd like to discuss today are the two major asset classes, property and shares. We get asked from time to time, am I better off investing in property or shares? Or am I better off selling my underperforming property to invest in shares? These are fairly simple questions that unfortunately don't have very simple answers. They often aren't fair comparisons either because investing in property typically involves leveraging and investing in shares typically does not involve leveraging. Now, obviously, of course, it's possible to leverage into shares and it's possible to buy property with cash, but the most common scenario for most people is to leverage into property and invest in shares with cash. Now, I'm sure most people would guess that if both asset classes were to perform exactly the same, i.e. provide the same percentage returns every year, that property would outperform because naturally you're holding a much larger asset through leveraging, which through the power of compounding will grow at an exponential rate over the years. Therefore, what I'm going to explore today is what is the minimum level of performance required from property in order for it to outperform shares. And when you get into the detail of it, there's actually quite a lot to consider, such as property expenses, interest rates, negative gearing, personal tax rates, the breakdown of income versus capital, and then also franking credits from shares. In order to make this comparison, I've run the numbers onto like-for-like scenarios for you. So let's assume someone has an income of $200,000, general living expenses of about $100,000, and they have $200,000 of cash savings. And for simplicity, they have no other debt and no other assets. So their options, very simply, are they could invest the cash in the share market, or they could go to the bank, use the $200,000 as a deposit, borrow $800,000 from the bank, assuming, of course, they meet serviceability, which they probably would, and purchase an investment property worth $1 million. Now, of course, they'd have to pay about $55,000 in stamp duty in Victoria, so let's assume that they add that onto the borrowing as well. They borrow that amount. Now, let's assume that the interest rate on their loan is 6.5% for the next year, but to make things fair, most people would expect interest rates will come down from their current levels. So let's assume 3 interest rate cuts of 0.25% over the next 4 years. With the property, let's assume a gross rental yield of 2% and capital growth of 6%. So 8% overall performance before expenses. Let's assume the typical property expenses such as rental management fees, maintenance, insurance, rates, these all reduce the gross rental income by 35%. Then we'll also add land tax in Victoria and loan interest on top of that. And if this person channels all of their surplus cash flow towards paying down their debt, in 10 years' time, I calculate they would have a net asset position of about $1.1 million in future, and that's about $920,000 in today's dollars. And then in 20 years' time, they would have a net asset position of $3.2 million, which is about $1.95 million in today's dollars. If we now consider the share portfolio scenario, the individual could invest the $200,000 in a share portfolio, reinvest all of their dividends, and continue to invest all of their surplus cash flow into the same share portfolio over the coming years. So in terms of performance, well, the Vanguard Australian Share Index Fund has returned an average of 8.31% after fees over the past 27 years since its inception. And of that performance, it consists of 4.44% income and 3.87% capital growth. Now, of course, you probably wouldn't just invest in the Australian share market. So if you look at the international share market, the Vanguard International Shares Index Fund, which tracks the MSCI World Index, has returned 7.55% per annum over the last 27 years, consisting of 2.92% income and 4.63% capital growth. Therefore, a portfolio combining Australian and international shares, I'm going to assume a return of 8%, so the same as the property. But a breakdown of this performance is 3% income and 5% capital growth, and I'm going to assume 30% franking. Under this assumption and this situation, in 10 years' time, the same individual would have a net asset position of just over $1 million, which is just a touch under $800,000 in today's dollars. And in 20 years' time, they'd have a net asset position of $2.8 million or 1.7 mil in today's dollars. By comparison, even though the percentage performance of the shares and property are the same, 8% before fees and expenses, and the property carries a lot more expenses, the individual's net asset position will be about $231,000 greater under the property scenario. Now, this is no surprise, I guess. This highlights the power of leveraging, and that's what most people would assume, I guess. But the question then is, at what reduced level of capital growth would this individual have been better off investing in shares? Now, the answer, quite surprisingly, is not actually that far below 6%. I calculate it to be 5.4%. Therefore, what that means is mathematically, for this individual, if the property experienced capital growth below 5.4%, then they would have been better off investing in a share portfolio. However, one thing it's also very important to consider are the potential capital gains tax implications under both scenarios. If this individual plans to never sell their investments, then the CGT implications are irrelevant. But if they did plan to sell their investments in 20 years, they would understandably pay more CGT with the property than they would with the shares, because the property performance is derived mostly from capital gains and it was starting off a larger asset base. If the individual were to sell their property in 20 years whilst still working and still in the top tax bracket, they could face a CGT bill of approximately $518,000 compared to $262,000 with the shares. Interestingly, if we look at their net asset position on an after CGT basis, the property would need to experience capital growth of at least 5.8%, so higher than the 5.4, in order to put this individual ahead over the share portfolio on an after-tax basis. And look, it's worth noting here that this individual is still working and they're in the top tax bracket at the time of this sale, which doesn't help. And in reality, they might choose not to sell the property at that point in time. They'd probably wait until they've retired to take the capital gains tax hit. It just makes sense from a tax perspective. But as a worst case scenario, this just highlights the tax that they could pay. So look, as a side note, if the client was to retire in 20 years and have no other assessable income and choose to sell their investments at that point in time, the CGT would obviously reduce a lot. So out of interest, if they were to sell the property once retired, they would pay about $456,000 in capital gains tax. But if they were to sell the shares in that same year, they would pay about $228,000 in CGT. But if they were to sell the shares down evenly across 3 years, and assuming there's no future growth into those 3 years, they would only pay a total of $161,000 in CGT. So this is interesting as it just highlights, the benefit of liquid assets like shares and the ability to sell them down over multiple financial years. So getting back to the performance figures, I must admit I was quite surprised by these numbers. I would have guessed that the threshold for an underperforming property would have been a fair bit lower than 5.4% or 5.8% after tax, just due to the power of leveraging. I would have thought it would have been closer to 4%. So there you go. We were surprised by that. But look, please don't take this information too literally and, go and sell your investment property tomorrow because it's only been experiencing capital growth of 5% for the last few years. Obviously, property, like shares, property market doesn't move in a straight line. There can be long periods of stagnant growth or drawdowns followed by short periods of fast growth. So, it's important to keep a long-term view with either asset class. In comparing property and shares, there's obviously a range of other factors to consider outside of just the performance and the numbers. So for example, property is a very lumpy asset. You can't exactly sell down parts of the property to support lifestyle needs or stagger capital gains over multiple years. There are some avenues through subdivision, that sort of thing, but generally the buy and sell, it has to happen all at once. Property requires a large upfront commitment. You can't really drip feed your way into it. And property is a bit of an unfair asset class in the sense that lower value properties, in our experience, typically tend to be lower quality, and higher value properties, which most people can't afford, tend to be high quality. Property also carries, a higher legislative risk, such as, the government introducing new tenancy laws, which we've seen down in Victoria, planning restrictions, land tax, which we've also seen in Victoria. Then you've also got, banks tightening on borrowing rules and borrowing capacities. So property certainly also requires more effort in terms of the acquisition process, the maintenance, dealing with tenants, property managers. But on the flip side, people love property because it's much more of a real asset. You can physically see it, you can touch it, you have greater control over it, and you have the ability to add value to it through improvements. Shares, on the other hand, are very liquid, which I've mentioned a couple of times, very liquid asset that you can gradually buy, gradually sell over time to support lifestyle needs or manage capital gains tax or dollar cost average to reduce market risk. Shares comparatively require very little maintenance, very little upfront commitment, and a very low starting balance. There's a lot of great low-cost ETFs available on the market that offer a diversified exposure at a very affordable unit price to really any retail investor. However, shares historically experience much greater volatility than property. I think being able to see the exact value of your share portfolio on a daily basis is actually a negative thing for most people. I think it creates fear and irrational decision making when you can see that your portfolio has dropped by 20% or grown by 20% in a short period of time. I mean, with property, you don't exactly know the market value of your property on a day-to-day basis. And that's actually a good thing, we think, because it encourages people to keep that long-term view, which you need with both asset classes. I mean, being able to quickly and easily sell shares, I think that's a negative thing because it makes people reactive. I mean, you can't just go and sell property on short notice. And no one would really do that. If they read in the news that the market's dropped, the property market's down, most people wouldn't just, be reactive and go out and sell the property. And that's a good thing because that's typically the exact time when you need to hold on to your asset when things have had a drawdown. So look, in summary, both property and shares have their pros and cons. We are very much asset class agnostic, which means we don't have any bias or preference to either asset class. We believe that, seeking holistic financial advice is important, and it's important to work with an advisor that has equal level of knowledge on both fronts. We think that, sound financial plan typically involves a combination of both assets, and really the asset split there is very much dependent on your personal circumstances. But look, with either asset class, particularly with property, the asset selection, it's really critical to ensure that your investments provide really good returns. So, if our analysis here indicates that you need growth of 6% per annum or more to be better off with property, well, I mean, in reality, our target for our clients when they invest in property is to get 7% or more in growth. I mean, that's really investment grade property, and that's what it should be doing. So as Stuart's spoken about many times in the podcast, buying the right property, it's absolutely paramount. And we think investors should get professional advice from a financial advisor first to make sure it's appropriate and it fits in with their overall plan. And then from a reputable buyer's agent, to make that really good asset selection. Buying a property, it's a big financial decision and you only get one shot at it. With each property, you might buy multiple properties and it's hard to unwind once it's done. And in my experience personally, I see more people make mistakes with property than I do with shares. Some people think that, you just go buy a property in a blue chip suburb and that's all there is to it. It'll do all the heavy lifting. It's really not the case. So look, as I can stress, professional advice is really critical to avoid making big mistakes, but also to making really good asset selection. Okay, so changing tack now, I'm going to help Stuart out by answering some of these listener questions. There's a lot of them, and I'm going to help Stuart out here by doing some of the heavy lifting. So I'm going to address a few of these. So we've got a question here from David. David asks, can you explain how capital gains are taxed in an investment bond? They're promoted as being CGT free after 10 years if you abide by the 125% rule. But my understanding is that capital gains are taxed at 30%, as is income, and there's no 50% discount after 12 months. If this is the case, it does not seem very tax effective compared to investing in your personal name, even at the top tax rate. So interesting one, David. So let me just confirm a couple of things about investment bonds. So investment bonds, there's really not much difference between income and gains. It's all just considered earnings. So there's really not sort of, when you're investing personally or through other entities, there's a clear delineation between, income and gains. There's really not in the investment bonds. It's all just earnings. And you'll see it represented if you look at their material. It's all just earnings, and that's how it's treated. So you're right in saying, yes, there's no tax payable on withdrawals after 10 years. That's right. And then also, even as you get closer to that 10-year period, the amount of tax you have to pay reduces a little bit. So, for example, in year 8, the amount of tax that you have to pay is reduced by a third. And then in year 9, it's reduced by 2/3. And then by year 10, the tax you have to pay on the withdrawal is nil. So how it works, I mean, even before that, so if you withdraw it within the first 1 to 7 years, you'll pay tax on the earnings, but you do get a 30% tax offset, which is kind of much like you would if you invested in a company and the company pays 30% tax rate, you'd get the franking credits for it. So it's similar to that in a way, but I think the real benefit of the investment bonds is you hold on, and if you can hold on for that 10-year time frame, then there's really no additional tax you have to pay from that point on upon withdrawing the money. Something to be aware of, so the 125% rule, I know you've just commented on that. I thought I'd just mention that's a really big one to watch out for. I've seen it a few times. Clients get caught out by it. It's a commitment. So you have to commit really to making the contributions. So if a client, for whatever reasons in their personal circumstances, forgets to do contribution one year, so say, every year they're contributing $50,000 to the investment bond, and then one year they forget to do it, then the next year they're bound by the 125% 5% rule, which basically means that they can put next to nothing in. And it kind of then mucks them around in terms of their long-term plan. So it's, you've got to be pretty committed, and you've got to make sure that your contributions to the investment bond are consistent and you don't miss a year, because then you run the risk of having to go and potentially reset that period of time and you go back to year one again and you're further away from that goal. So David, you're also right that, the investment bonds don't have the 50% CGT discount after holding an investment for 12 months. That's correct. Nor would it if you were investing in a company. It's a benefit that's attributed to personal, if it's invested in personal names. So you're right there. So look, is it still a tax-effective investment strategy compared to investing in your personal name? Well, it is. If you're still in the top marginal tax rate, you'd be getting taxed at 47%, whereas you can house these investments in an environment where it's capped at 30%. So there's a 17% difference there compared to if it was invested in your personal name and you're in the top marginal tax bracket. Good thing as well, the investment bonds, they don't have to be declared on your personal income for your tax return purposes. It's completely separate. It doesn't have to be declared, and it doesn't matter. It doesn't go towards anything from that perspective. So it is completely separate, and you do get, for a period of time, if you're in a high tax bracket, a better tax arrangement there. And particularly so if you're going to be withdrawing the funds whilst you're still working and you're in a high tax bracket. If the idea, a lot of people use these for, building up funds to pay for school fees, so investing for the kids to then have school fees. I think one of the products by some of the investment bond providers are sort of aimed at that design. If you're going to be doing that, you're still going to be working likely, and, you'd be withdrawing if it was in personal name, taking the capital gains hit when you're in the top tax bracket whilst you're working. So they do have benefit from that perspective, and that the money gets withdrawn tax-free regardless of what your personal income is at the time. And look, I guess for interest's sake, some people might ask, well, what's then the difference between investing in a company? If you set up an investment company and housed a share portfolio within it, that's going to get taxed at 30% as well. I guess the difference is, so when you sell down and then you want to withdraw your investments from the company, you're going to get franking credits, so for the tax already paid, but it needs to be distributed as dividends. So you're still going to have to pay top-up tax. So if you're then in the top tax bracket with the income from the investments as well as other income that you might have, and that might put you up in the top tax bracket of 47%, you're still going to need to pay the top up of 17% tax. So investment bonds are a little bit different in the way that there's no top up and it comes out tax free regardless of what your personal income is. The next question now is from Philip. Philip says, I had a question about debt recycling. There's a lot of information around about structuring of loans to do this. There is little information about constructing a share portfolio via debt recycling, i.e. should it be high dividend, good growth approach? Do you have any examples of principles of constructing a share portfolio using debt recycling? So look, before I answer that question, Philip, debt recycling, I just wanted to flag, it's, for those that don't know, it's effectively, broadly speaking, about converting bad debt into good debt. And really what that means is it's about converting non-deductible debt to deductible debt. Now that's broadly the definition of it. There's many different ways of doing it. There's a lot of different avenues of which it can be done. So it's a very broad approach. But I'm going to take it, I kind of get what you're saying, Philip, here in the way that you'd be drawing an investment loan to construct a share portfolio. So look, my thinking then is, look, it really depends on what are your other personal circumstances, and particularly, where are you at in your career and how close to retirement are you and what's your personal income. I'm going to take a guess here and say that if you're going to be taking on this debt for investment purposes, that you're probably in the accumulation stage, so you're probably still working. So then it gives rise to, negative gearing benefits, and that's what I'd be targeting it to. So if I was in that situation, and assuming that is your situation, I think then the focus then for the share portfolio should be, I think, more on growth and less on income. So that's really, because then to preserve the negative gearing benefits, you want less income because then it's more negatively geared, and then you're getting more growth, which you're not getting taxed on every year, the capital growth. And then you can choose when to, realize that capital growth, those capital gains at the point in time where you want to. So I think really the idea for the share portfolio is focusing more growth and less income. So in doing that, looking at asset classes, I'd probably be going more international shares over Australian shares. International shares have a higher proportion of growth to income, whereas the Aussie market, we're big on dividends here, and we're more of a dividend focus in the Aussie market. You could look at, putting an allocation in there, a certain percentage, not all of it, of course, to emerging markets. They're typically low income and more growth. It's been a little bit underperforming at the moment, but I think it's good time to have a little bit in that. And then in terms of, within the markets, in the share markets that you're looking at, potentially more small and mid cap than large cap. So small and mid cap portions of the market typically have lower income profile than, if you compare it to BHP or something like that, or the banks, they have a high income profile. But, in any market, the smaller and mid cap typically have less distributions and less income. So I think that that's what I'd be focusing on, broadly speaking, is, just trying to more growth and less income in the overall performance. Another thing I might consider doing is avoid hedging. So for international share investing or even other bonds and the like, you can hedging, because hedging, if there's a return from hedging, it has to be distributed as income. So again, it comes back to that idea of trying to minimize, I think, the income and have more growth from it. So hedging investments, if there's a currency return from the hedging, that's not gains. It has to be distributed as income. If you go and look at, something like a Vanguard International Share Fund hedged, if you look at it, there's, distributions there from the hedging proportion. And so they have to be distributing that. So maybe that's something to be aware of and have a look for. And then look, flip side of that, Philip, is if I've read your situation wrong, and you really don't want to have sort of negative cash flow, negative gearing benefit from this, and you might be getting close towards retirement, you don't want to have any holding costs for holding this investment, well, then you'd sort of do the opposite of what I've just said. You'd try and have it a little bit more income focused so that it can even out the cash flow and get it closer to neutral cash flow. I mean, with current interest rates, you might struggle to you might get it just neutral cash flow, but as interest rates come down, you should be able to get it a little bit more positive cash flow in future years. So if that was more of your focus, you'd sort of swing it a little bit more to be, I guess, a little bit more income focused so it can level out that holding cost for you. All right, next question we've got here is from Matt. Matt says, thanks for all the content. I had a question about a career change. I'm not happy in my current role as a primary school teacher, and I'm passionate about the finance industry, and I consume a lot of the content. I don't have any experience in the industry. However, I'm considering a career change into mortgage broking. Could you please list the pros and cons, the employment opportunities, and that sort of thing? I know there's increased compliance requirements and so forth. Please use my first name only. I'm guessing Matt doesn't want his boss to know about that. That's fine. So look, Matt, just for full disclosure, I'm not a qualified mortgage broker, but I work with them closely every day and I have done for many years. So I think I'm fairly well placed, and our advice process is very much intertwined with the mortgage brokers in our team. So what I'd say to answer your question in terms of pros, look, it's a great job getting to help people. I mean, I guess you probably get to help people. You enjoy helping people in your current job, but it's a good feeling when you get to help people buy their first home or buy an investment property. There's a bit of good satisfaction in there when a sort of a property is settled, or they've secured a good property and you're getting to helping them to get into a property that they love, their forever home. That's great. You get to help people out of bad situations as well. People not often, sometimes come to us in a bit of a jam. They've got a situation where the debt's getting too high and they just can't meet serviceability and they're going to be forced into sell assets. It's really good when you can come up with a sort of a flexible and strategic solution that helps them stay afloat and stay, on top of their debts, and then enable to hold their assets longer term and not be forced into sell anything. So yeah, there's a good feeling there in terms of helping people out in good situations and bad. Look, I like it. You get a really great insight into the property market as well. You also get to see what a lot of buyers agents buy in terms of, getting an idea of what good quality properties are, what they like. You get to see what other people are buying, where properties are selling and what they're interested in. You get a good feel for the economy, I feel, as well, seeing how much people are taking up debt and lending and buying investments. I think it's a good indication of, consumer sentiment more broadly, I guess. And look, you learn a lot, not just about loans, but a lot about personal money management and investment and finance in general through mortgage broking. And look, particularly if you work somewhere where you work closely with, accountants and financial advisors, if there's a holistic approach there, you'll be learning a lot in terms of other areas just outside of mortgage broking. In terms of the cons, look, I'd say it's quite competitive. I think the industry, there's a lot of mortgage brokers out there. But look, what I'd say is, if you can stand out as one that's, ethical and offers sound advice, and it's not just transactional, and it's not just about getting the loan, it's actually about, taking care of clients, making sure that they're borrowing what they should borrow and that there's a long-term plan there in terms of repaying the debt, then you should be in good stead. But look, it's quite competitive, and, I guess that's one of the cons of it. Look, another con is that, the income, I guess, from a business perspective can fluctuate. So it's impacted by interest rates, it's impacted by the economy. There's not as many people taking out large loans at the moment just because of interest rates and where the economy's at and the cost of living. So it is impacted by that. That's affected by, the level of business that you experience. So look, I guess that's a couple of things. If I could give you a bit of advice, my advice would be, if you're going to get into it, try not to be a type of mortgage broker, and there are some out there that's, just a product comparison mortgage broker, where it's just, okay, how much debt do you want? All right, $1 million. This is, okay, I've reviewed 10 different lenders and this is the best way to get $10 million. I mean, you're not really going to mark yourself out as, and get good business in that way. I think really what you've got to be doing is, being someone that offers personal advice. So making sure you're not just, leveraging people up for debt that they can't take, and understanding, well, what is it that they're investing in? Is that sound investment? And, how much should this person actually borrow? Even though they can borrow $1 million, should they be? And, what's their long-term plan in terms of repaying that? So, I think you can really carve yourself out as having that difference in the market. That's what you should do. And look, touching on compliance, yes, compliance has increased, to your point there. Banking Royal Commission, some things came out of that. Bank lending rules at the moment, it's a big issue. So the 3% buffer that Stuart talks about quite a bit, it's quite high, and so that's a difficulty. So there's some regulatory burden, I guess, there, and some impact from government rules, which sort of impact that business. But look, those are issues that we work through. But look, finally, I'd say, Matt, great work for asking the question, though. You're doing exactly what you should. If you think about making a career change, the first thing you've got to do is reach out to people in that industry and, do your research and find out what it is. And, if it's actually something that you like before you just, sort of launch into it. At some point, you will need to take a leap of faith, I guess, in changing careers. But you're doing the right thing in asking questions and doing your research. And, I'd encourage you to speak to more people about it to get a good understanding if it's something that you really want to do. So I've probably got time for one more question now. So the next question is from Mark. So Mark has another question about debt recycling. Bit of a long-winded question, so I'm going to paraphrase it a bit here. But his question is around debt recycling strategy where there's an existing share portfolio in place. Would it make sense to sell down the share portfolio, split your home loan, pay down the portion, and then borrow to invest the same amount of funds, thus converting your home loan from non-tax deductible to tax deductible? So in this example, $200,000 share portfolio, and then he's got the home worth $1 million and then a mortgage worth $500,000. Split the home loan in two, so a $300,000 and $200,000. Sell down the share portfolio, pay off the $200,000 portion of the home loan, then redraw the $200,000 loan to purchase the same or similar share portfolio, effectively restoring the same debt, asset ownership levels, and in order to claim the tax deduction from that new $200,000 investment loan. So, yep, that'll work, Mark. Yep, that's certainly all feasible in terms of your strategy and in practicality and in theory. Yeah, that works fine. And that will do that. It will have that effect. It will convert 200,000 of non-deductible to deductible debt. A couple of things I'd just be concerned about not concerned about, just considerations, I guess. Biggest thing there is, what are the capital gains tax implications in selling down your shares? That's probably the big one. And that's probably the most restrictive factor that we have with clients where, we sometimes have clients where we would like to change the ownership structure of their share portfolio, move it to the spouse, move it to another entity, a trust, a company, super, for example. But it's often restricted by the capital gains. And we just can't run the numbers to feasibly see that it's worth taking the capital gains hit in order to change ownership. So there's a little bit different here. You're not exactly changing ownership, but you're going to have to sell the shares in order to pay down the debt and then redraw it and buy back in. So you're taking the capital gains hit. So I guess the question is, how much of the capital gains hit is it? How much will you have to pay? And that will kind of dictate whether it's worth it or not. And I guess in terms of weighing up the benefit that you'll receive by making that $200,000 tax deductible, if you think about it, let's assume if your home loan interest rate is 6.25%, that's kind of your after-tax interest rate is 6.25% because your home loan's not deductible. But let's assume then if you take a investment loan, it's probably going to be slightly higher, the interest rate. So let's say 6.5%, but that's going to be deductible. And if we assume, if, for example, you were in the top tax bracket, you're paying 47% tax, that 6.5% interest rate on an after-tax basis is more like 3.44% interest rate, kind of just accounted for the tax deduction in it. So on an after-tax basis, it's more like 3.44%. So then the difference there between 6.5 and 3.44 is about 2.81%. And then based off a $200,000 loan, that's $5,620 in the first year, and then every year after that. So I'd use that, Mark, as a guide that, you're going to be on an after-tax basis, $5,620 better off. It's up to you then in terms of what the capital gains are to weigh that up. If the capital gains was only $5,600, well, in theory, you're going to break even in the first year, and then by the second year, you're going to be benefiting by $5,600. But I'd use that as the guide to work out whether it's worth it or not. The other thing I'd just make mention of is, look, really, it's a bit of an aggressive strategy in just completely selling $200,000 share portfolio. We generally always say there's got to be a compelling reason to sell investments. You really, Stuart talks about it a lot. You make the money in the holding, and it's got to be compelling to sell an investment. Really, you do well in just holding. And we have clients with lots of different investments that came to us with those investments. And although we don't think they're the greatest thing in the world, and if we had, cash to begin with, we wouldn't invest in them, there's got to be a compelling reason to sell them to, transaction costs and capital gains. So, yeah, I think, you've got to consider then you're basically going and selling some shares in there, which I'm guessing might be good shares and might not want to do that. They might be good holdings. I mean, shares is a bit different to property in the way that you can just go back and buy the shares again, if we think that they're good. With property, you can't really do that. And getting forced to sell a property is really not good because, if you've got a great property there and you have to sell it for whatever reason, that's not a good thing to get rid of a good investment. The other thing I'd mention is, you're going to have a little bit of time out of the market, to pay down the loan, then redraw it, then go and invest in it. It probably isn't going to be a huge amount of time, but share market's pretty volatile and there's big upswings and big downswings. So there's a little bit of short-term risk there in time out of the market that you'd experience. Probably also got to consider, there's transaction costs, brokerage costs. So if it's just, if you've got this just in a share trading account, you're going to pay some brokerage on the way through. It's probably not going to be massive, but you've got to factor that into your calculations as well. And then what I do then is if you're selling the investment, selling the shares, and then you're going to go and place them again, well, then you've got an opportunity to make some decisions there. You're starting from cash once again. So I think at that point in time, you need to then consider, well, whose name should the shares go in? So ownership structure, the platform that you're housing them within, whether it's a brokerage account, a wrap account, whatever it is, another type of investment account. You've got an opportunity then to restructure that and restructure the whole share portfolio. So, ownership, have a think about it. Who's it going to be best to be placed in, or entity is it going to be best to be placed in? And then you'd also reconsider your share portfolio. So I'd have a look at it and, I know with, personal portfolio or clients' portfolios, there's some things there where if, we would like to change them, but, it's not worth doing a large capital gains hit. But if there's no capital gains left, you've got a chance there to just completely reconfigure your portfolio. So I'd have a good think about what you're going into in terms of where it's at in the market and, what's going to be a good investment moving forward. And then just the other point is then you'd make sure you obviously get advice and speak to people about this to make sure it all works, but you'd want to be really sure that you get the loan approval first. So, you don't want to go sell the share portfolio, pay down the mortgage, and then find out you can't get an investment loan or the investment loan terms are not very favorable. So you'd want to have that locked in and approved before you then execute it. And you'd probably want to speak with someone beforehand just to, review your personal circumstances, because this isn't personal advice, as we say, just to make sure the overall plan works and it's feasible. Yeah, I hope that helps, Mark. Okay, I think that's enough for today. That's all I've got time for. Thanks for listening. Bye for now.